Welcome to Moving Mom and Downsizing Dad, the podcast that prepares you for one of life's toughest yet inevitable moments, stepping in when your parents need you most. Hosted by Chris Spade, a senior real estate specialist with Keller Williams Realty. We'll dive deep into more than just moving. We're talking smart financial planning, making tough decisions with confidence, and strategies to avoid being caught in crisis mode. Join us for real stories, expert insights, and actionable steps to stay ahead of the curve. Now, here's your host, Chris Spade.
And welcome back, everyone, to another episode of Moving Mom and Downsizing Dad, the podcast where we help Gen Xers navigate their lives and we help bring practical tips to we talk about everything. We talk about finances and downsizing, decluttering, and all kinds of fun stuff. And today we are talking to Brandon Burns. Brandon is the president of Vanguard 1031 Exchanges. He is a certified exchange specialist. He has a background in real estate investing, and he's helped facilitate roughly 4,000 1031 exchanges. That is a lot of 1031 exchanges. I don't think I haven't even closed that many real estate transactions. So you have done a lot more than I have right now.
Well, a real estate transaction, there's a lot more that is involved with that, right? You're a man of many talents when you're in your position. And I know that you have probably 10 hats that you're wearing at a time. Well, a 1031 exchange, sometimes people have asked me, what about certificate of occupancy, or what about the condition of the property? And a 1031 exchange is a little bit more of a financial thing than it is a true real estate thing at the end of the day. So that certainly makes it easier to get more done when I don't have to wear 10 hats.
Yeah, that's for sure. Well, let's get to it, because the basic, principle of our podcast is giving seniors options when it comes to their investment properties, because as we know, a lot of times the rental income is used to pay for living expenses, right? Whether that's, living in their house and getting a caregiver, or moving into an assisted living or retirement community. So the money from rental properties is important. And in some cases, it just makes sense to exchange it into something different, right? So first of all, just tell us, for somebody who doesn't know, what is a 1031 exchange? What is that?
So there's two parts of the tax code that benefit people that own real estate that's worth more than they paid for it. Section 121 of the tax code says that if a property has been your primary residence 2 out of the last 5 years, or more specifically 24 months out of the previous 60 months, then you get $250,000 tax-free when you sell. If you're single, $500,000 tax-free when you sell if you're married. Section 1031 of the tax code is for someone that's selling a property they've used for investment or business purposes. And instead of giving them a tax break, this gives them a tax deferral. And so it's typically called a 1031 exchange. But the way I like to think about it, and if you would, is let's imagine you bought Apple stock the day it IPO'd, right? Apple is a great stock. You put in 10 grand, it's now worth $1 million. You've done really well. But maybe the last few iPhones have been the same leadership at Apple isn't there anymore. And so maybe you say, hey, you know what? Apple's had a really great run for me. So I'd like to switch that for Google stock, because even though Apple's had a great run, I'm not sure they're going to have a great run in the future. And you can't do that tax-free in the stock market, but you can do that in the real estate market. So, Chris, there's so many people here who have rental properties that have really appreciated over the past 10 or 12, 15 years, and they haven't raised rents commensurate with the rise in value, because most people are good people, especially if you have a good tenant. You kind of feel bad raising the rent on them, equivalent to what the market's doing, right? So one of the things I'm very consistently seeing is people that have purchased a real estate investment, a house, a duplex, something like that, 8, 10, 12 years ago, and they haven't raised rents very much, and their yield, their return on the value has gone from a decent return of 5 or 6% to now a 1 or 2% return based on the new value. And so there's a lot of people today that say, hey, this has been a great property for me. Let me sell it and let me buy something, literally even down the road sometimes, where there's been some repairs that have been done. Maybe there's a tenant that's paying market rent. I had a friend, she was a widow, and she told me, she said, Brandon, I have the best tenants in the world, I think. I said, well, tell me why. She said they pay rent early all the time. They paid rent early, 5 days early this month. So that's
Those
great.
are good tenants.
How much do they pay? She said they pay $1,500. I said, well, what kind of property is it? And it was in Escondido. It was a 4-bedroom, 4.5 bath house. I said, of course they paid early. I would have paid for a whole year.
Yeah, I would have too.
So, she was looking at it, her husband had passed away. She was looking at it based on the numbers that they bought the property for 8 or 10 years ago, not understanding that rent today should be $4,000 or $5,000. And in doing so, while I think it's important to be kind to people, she wasn't able to pay for private school for her son. She was driving an older car, things that really could have changed her life with an extra $3,000 a month, right? So that's where a 1031 exchange comes in. It allows you to, sell a property and buy a property, or even buy multiple properties and potentially increase your income, potentially avoid large repairs like replacing windows or roofs, where you're going to have to spend $30,000, $40,000, $50,000 sometimes.
Yeah, we talk about, when I talk about with homeowners thinking of doing a 1031 exchange, I always tell them, when you're a landlord, you're dealing with the toilets, tenants, trash, and taxes. So do you, especially the tenants, toilets, and trash, we can't avoid the taxes, right? But do you want your property, which has probably got a lot of deferred maintenance, or do you want to get into something, like you said, to your point, that's a little bit nicer, that isn't so in rough shape, right?
Right. And at the same time, maybe get an extra $2,000, $3,000, $4,000 a month at times.
Right. So let me ask you, so how can a 1031 exchange help older homeowners defer the taxes and prefer wealth when downsizing or relocating?
Yeah. So again, Section 121 is when it gives you that tax break when you sell a property that you've lived in 2 out of the last 5 years or 24 of the past 60 months. Sometimes people don't realize that they can combine a Section 121 and a Section 1031. So, I helped an older couple where they had a duplex and they lived in one half and the other half was an investment property. And we're seeing this more and more often with where there's a property that maybe has an ADU or 2 on it, right? So those are considered investment properties. And the part that you live in, you can actually kind of double dip on the tax code. And so that can be really beneficial. Or if there's a property that it used to be their primary residence, but maybe they kept it as a rental, moved into a different property 4, 5, 10 years ago, and it's been a rental for some time, allowing that to be moved into a property where maybe there's less hand-holding, there's less maintenance, or better tenants, or sometimes even people move states, right? So you can sell something here in San Diego, and especially if you've owned it for a long time, it's paid off, and you can buy something in another state where you maybe buy a fourplex for the same cost sometimes as a single family here. So that 1031 exchange just allows you to do that without having to pay those significant taxes, and reducing the tax burden is typically somewhere between 30 and 40% of the profits. So it allows someone to keep 30 to 40% more income going forward because they don't have to give up that much to the government along the way.
So you just brought up something, and just for clarity purposes, so when you were describing the owner lives in one and they rent out the other, when you do that type of exchange, is that what is referred to as a split exchange?
Yeah,
Yeah.
exactly.
Okay. Okay. So we're on the same page. Just want to make sure.
Yeah. So they're able to get Section 121 benefits, either 250 or 500,000 tax free for the portion of the real estate that they live in, and then for the portion of the real estate they don't live in. And this is as long as they're separate addresses. This doesn't work if you're renting a room or something. But if there's a separate address or a separate house or
Mhm.
a clearly separated different living quarters, then they can use Section 1031 and roll that into another piece of real estate without paying taxes along the way.
Let's talk about the timeline because there is a specific timeline that you have to follow. The government says, here's the timeline. Talk about that. So when somebody is thinking about making this move and they're thinking about selling, what does that time frame look like and how many properties do you have to identify?
Great question. So yeah, the government wants the money back in the economy and wants it back, working in our overall GDP at some point. And so they put two clocks in place. Both clocks start and run simultaneously on the day someone no longer owns a property. So it's whatever day is on the deed that transfers it to the other person, or the settlement statement showing all of the costs involved and the time of the closing. But both clocks start. The first one is the identification clock. The IRS wants a plan in place and a couple of properties written down that someone may or may not end up purchasing in those first 45 calendar days. And then they want whatever's going to be purchased at some point within 180 days from the sale, which is 6 months. The reason the government uses days instead of months is because they want to be clear, includes weekends and holidays, Christmas. And sometimes people ask, Brandon, are there, what if, I was closing on day 175 and suddenly, it couldn't close for an extra 10 days. And is the government going to work with me? Is the IRS going to give me additional extensions? And unfortunately, the IRS, they're not our friend, right? They're kind of like the mafia. They hope that you can't perform in the time frame allotted.
And
so it's really
taxes.
important. Yeah, they want their piece, right? So it's really important to have someone like you in their corner. Often it's good to start looking once you have a buyer for your property, so that you can either have more time to make a good decision, or potentially even find that replacement property and get it under contract about the same time that you're selling your relinquished property, the property you've owned for a while.
So let's talk about the properties that you identify, because it's my understanding that when we close on the property, I sell the property and we close and you're handling the exchange, that the my seller, now buyer, has to purchase one of those properties they've identified on the list and given to you. Is that correct?
That's correct. Yeah. So what the IRS doesn't want is for somebody to say, well, I've identified, every property in North County, San Diego, or to say, hey, well, I'm going to go back and forth and change my mind all the time. So people can change their mind in that first month and a half, in that first 45 days. You can change your mind every hour, every day, every week. But at midnight on the 45th day, whatever properties they've selected and written down, those are the properties that they're tied to going forward. So it's really important. And this is true for single family houses, and this is true for $100 million office buildings and shopping centers. So it's really good for residential, if you can, to have something under contract in that first month and a half. And that's why it's good to start looking ahead of time, right? So once you find them a buyer, they've got 21 to 30 days or so that before close. That's a great time to start looking. So you have that time, and then you've got the 45 days. So that can get you 2.5 months roughly on average. And usually people can find something they like and hopefully get it under contract during that time period.
Yeah, I always tell people, the advice I give people when we're going to go through this process, and first of all, I always tell them, listen, now that we've put your home on the market, let's start shopping, because even before we get that buyer, I want to make sure, because I know so many people who have fallen through the cracks because the representation they were getting was just wrong and they didn't know. And then the government comes knocking going, oh no, it's time for me. And then the state of California comes knocking and says, oh, it's time for me. And they get their money out of that, right? Um, I have another question for you. So let's talk about inherited property. So speak to this if you can. How does the 1031 exchange affect inherited property, and what should any Gen Xers know if they inherited real estate from their parents?
Yeah, so that actually flows both ways. So that's a great question, and I want to address it, but also a little bit more. So a 1031 exchange is a great estate planning tool because when someone passes away, there's what's called a step up in basis. And what that simply means is that their heirs, when they receive that property, when their parent has passed away, whatever the value is, that's where the taxes start for that next generation. So for example, let's say that somebody had bought, a nice single family house in Claremont in the 70s for, 150 grand. Today it's worth 1.2 million. If that person did a 1031 exchange, bought, maybe a duplex in North Park or something, and 5 years later that duplex is worth 2 million and they pass away, when their kids inherit it, their taxes start at that 2 million. So if somebody had sold it in their lifetime and hadn't done a 1031 exchange, they would have had to pay 30 to 40% of the difference between their purchase price, let's say 150 grand, and the sale price of 1.2 million. So they would have had a plus or minus $400,000 tax bill. But when their children inherit it, all of the taxes that were incurred in the life of the parent, they get wiped away. So that might be a little bit lengthy answer to your question, but if somebody inherited a property, that whatever the value is at that time, that's where their taxes start. So if they inherited a property and it's worth 1 million, it doesn't matter that their parents bought it for 150, their taxes start at the $1 million mark. And so a good way and something that's important is if someone inherits a property, hiring you to do some comps and prepare a quick broker's opinion of value to say, this is what we think it's worth. Does it make sense to sell it now? Is really a prudent thing to do because often people will inherit a property, they won't really know what it's worth, and so it's harder to make an informed decision on should I sell it now, should I wait 5 or 10 years and then sell it, and if I waited, and if I have waited 5 or 10 years, what are my tax obligations? Should I sell because of that stepped up in basis and the higher tax threshold?
Let me ask you this, and get your opinion on this, because I've talked to some of my senior sellers, and parlaying off of what you just said, one thing that I stress to my clients is let's figure out a way and come up with solutions so that way when you're gone, there are no fights between the kids, right? And so I want to make sure that people know. So when you go to sell a property, like you said, like if it's worth $1 million or 2 million or whatever it is, the replacement property, what does that look like? What price? I want to hear from the expert. What price do they have to buy? I know the answer to this, but I want you to tell everybody because you're the expert.
Yeah. So there's a couple of major hurdles in doing a fully tax deferred exchange. The first one's time, which we talked about, and the second one is value. And not as many people know this. You're one of the better agents, Chris, so clearly but essentially the IRS wants the same amount of money to stay in the economy. So it doesn't, as you look at a 1031 exchange, it doesn't matter to the IRS, or at least they don't look at what someone paid for the property, what cash is going to come out, what debt they have on the property. They simply look at the net sales value, which is the gross sales price minus some select closing costs. So, but essentially, if you sell for $1 million, you have to buy $1 million worth of real estate. And so, because again, the IRS wants the same amount of money to stay in the economy. And they don't care if you buy two $500,000 properties. They don't care if you buy, three $350,000 properties, right? They simply want 1 million or more of real estate to be purchased by the end of the 80-day time period in order for someone to get the full tax deferral. So you're absolutely right. If somebody has, some significant equity and they can say, okay, well, we don't want any fights to occur. We're going to sell this one property and we're going to buy two or three because they have two or three heirs or children. And that allows them to really kind of cleanly divide it up and prevent any issues after they're gone.
Exactly, because one of the things I've talked about is you can go and take this, then buy three houses, then it's Bobby and Susie's house, right? And then Mark and Jill get this house, and then your single son who can't find a wife, Brandon, right? No, I'm just kidding. Who is, then you've got your properties, and then everybody's got their own. And then you don't have to worry about it when mom and dad pass away. So you can just buy multiple ones. So let's talk briefly, because we mentioned this when you and I talked on the phone the other day. If somebody doesn't want to deal with tenants, toilets, trash, or taxes, there is a 1031 they can do into what's called a DST. Can you just talk a little bit about what that is and what that looks like, and how do we avoid the trash and the tenants with that? Because they're still tenants, right? But we don't have to deal with them.
Yeah. So, somebody asked me the other day, at 41, what is my biggest takeaway from real estate in the last, 15 or 16 years that I've been in the industry? And my biggest takeaway is that real estate is not passive. People talk about passive income all the time, and it's just not. Even if you own, triple net commercial, where the tenant's in charge of everything, there's still work that has to be done. So in the tax code in section 1031, a 1031 exchange is called a like-kind exchange, and that's how the IRS describes it. But they have the definition of like-kind fairly broad. So they've defined it as real estate where you go on title. So a good way to think about it is any real estate where you pay property taxes is a like-kind exchange. You sell a property where you're on title, you buy a property where you're on title. However, that doesn't always work perfectly for everyone in every circumstance, right? So, going back to what we just talked about, if you sell a property for $1 million, you have to buy a property for $1 million. Well, what if you have $500,000 in debt on it, right? Now, as an older person, maybe in retirement, having to take out, a new loan perhaps, or, having to contribute more equity into the purchase of the new property might not be ideal. So in 2004, the IRS finally said, okay, we are going to let a fund type structure be eligible for these pre-tax 1031 dollars. And so as they were deciding what type of fund type structure, they decided on what's called the Delaware Statutory Trust. So most people are more familiar with a REIT or real estate investment trust, but that's not eligible for pre-tax dollars. A DST or Delaware Statutory Trust is. And the reason for that is because the IRS put some kind of guidelines and restrictions on it to try to make it a little bit safer. So you can't do any development inside a DST structure. You can't refinance. It's among a number of other things. The IRS tried to design it so that inside that structure, you've just got a good real estate asset that doesn't really have a lot of moving parts and it produces some good cash flow. So because of that, and every one of these DST funds are different, but in general, these DSTs tend to be a little bit on the safer side. They tend to be larger, more institutional properties, whether that's an apartment complex, a bunch of CVS, buildings leased to CVS, where CVS has a 10, 12-year guaranteed lease on there, self-storage, a number of other things where you have these properties that aren't having a lot of moving parts. usually have some pretty decent cash flow and are professionally managed. So that way someone else is doing the work and it becomes passive to you. So it allows someone to be passive. It allows someone to invest in something that may be safer or higher quality than they may be able to invest in otherwise, and sometimes can be a good option for people. I'd say 5 to 10% of our clients end up going into these DSTs. There was a gentleman who sold a 12-plex out in Ramona, and he hadn't raised rents kind of, where we started the conversation. He had good tenants for a long time, but he had to drive to Ramona a lot because there wasn't enough cash flow to pay for a property manager, and he had to fix microwaves, because they're older. And he sold that and went into a DST. He was able to double his cash flow, and he never had to drive to Ramona to fix another microwave. And I felt like after the fact, he was going to kind of tear up on the phone once that kind of sunk into him. So
No, that's the thing. I've been driving out to Ramona to show property, so I get that drive, right? And I live in University Heights, so that's a 45-minute drive. So I get it. I get it.
Yeah, totally. It's 45-minute drive in good traffic.
Yeah,
right?
exactly. And it was Sunday, so it was perfect. Like I had no traffic going that way. Before we wrap up, is there any sort of risks to doing a 1031 exchange that people should know about? Because I know there's some people sitting there listening to this going, this has got to be too good to be true. What are there any risks that we should mention to people?
Yeah. So when you do a 1031 exchange, just to real quickly hit on the major points, we've talked about time, we've talked about value. There's a financial hurdle where the exchanger can't have receipt of the funds, and they have to be in an escrow account, or at least any funds that they touch do become taxable. And then the fourth hurdle is an ownership hurdle. So the same taxpayer has to sell and buy. You can change title before or after, but it has to be consistent with the taxpayer so the IRS can track those deferred taxes. So a lot of times, when we have people that are kind of coming down to the end and saying, I've got a closing here in the next week or two, I'm not really sure if I want to buy another property. A lot of times what people will do, or at least look at as a 1031 exchange, is say, okay, it costs a little bit over $1,000 to do a 1031 exchange. And we charge per closing. So $995 when they sell, $295 when they buy. So if somebody's not sure, they can simply just start an exchange. And at any point, if they change their mind, they just let us know. They fill out a form as to where they want the money wired to or the check sent, send it the next day. So essentially it buys them, for $995, buys them 45 days to, go look at other properties with you and have more time to make that decision if they want to reinvest that in another property, or if they want to pay the taxes and do something else with it. So I think that's something sometimes people struggle with, especially if they haven't started looking for a replacement property, like you said. Mm-hmm. So, it can be good to have that extra 45 days, even if there is that $995 cost to buy that time to avoid taxes. Another potential thing to be aware of on the ownership hurdle, if you're wanting to deed it to your children, I always recommend bringing in an estate planning attorney. Yes. Because there's certain hurdles where if you put a property in someone's name, it could potentially trigger some gift taxes. So I would always have an estate planning if you're looking at moving an asset to the next generation. It's always good to have an estate planning attorney in place, especially, for example, if you were to transfer it to your kids, they might not get the step up in basis depending on some things. So it could be good to keep it in your name and just, have multiple properties where you could will, one individually to each person. So that can be important because a lot of people today are planning for the future and saying, okay, do I transfer title now? Do I put it in a trust? And it's important to be able to get that step up in basis. Yep. So you can avoid all those taxes that were accumulated in your life.
Yep. Awesome. Brandon, thank you. This was super helpful. Hopefully, our listeners got some value out of this, because I want to, be able to explain to people that this is a great opportunity to help mom and dad when you're when you need it. But I did want to reiterate, they can do a 1031 exchange anywhere in the country, right? Like they sell in
Yeah.
California, they can buy in Texas, they can buy in Minnesota, they can buy anywhere.
That's exactly right. It's part of the federal tax code. So the state lines don't matter. Now, you cannot cross a country line, which is really unfortunate, or I would own a beautiful condo in Rosarito. And you can't go to the territories, to the Philippines. They have different tax treatments, Puerto Rico. So it does, you as long as you're selling and buying in one of the 50 states, it works. You can sell in California, buy in Texas, sell in Texas, buy in Alaska. And one thing that often makes sense is California tends to be a great place to accumulate wealth with real estate, right? We've had this great appreciation, and it's a good place to create wealth. But it can be a harder place to have cash flow, right? So a lot of times what people will do is they'll say, okay, I've got a couple of assets that are cash flowing really nice in Utah or Arizona, but maybe I don't really need the cash. So maybe I'll sell those and buy something in San Diego, where the real estate values stay pretty strong and you have some pretty good appreciation. Or sometimes people say, well, maybe I'll sell an asset that has some great appreciation, but maybe I don't have cash flow because I need cash flow.
Yep.
And so they'll sell here in San Diego or somewhere in California, and they'll buy something in Arizona, Utah, Texas, Florida, one of these other places where the real estate tends to cash flow better. So depending on someone's life goals or current needs or even anticipated needs, crossing a state line can be really beneficial.
Awesome. Brandon Burns, thank you so much. I'm going to put all your contact info down in the show notes so everybody will get to see that. And I appreciate you being here. Thank you so much for picking up the phone when I called you about 10 days ago. I appreciate it.
It's always a pleasure, Chris. You're one of the good ones.
All right. Thanks, everybody, for listening to this episode. We will catch you on the next one. Bye-bye.